Hey guys, thanks so much for coming tonight. For those that don't know me, I'm Zhuoxun. I lead operations here at dYdX. Super stoked that you all could make it today. We've been sort of a little underground, under the radar the last couple of months, just building a bunch of cool features. So we're really excited to come and share that with you. Before we jump into, I'm just going to lay out the agenda really quickly, but before we do that, I have one very exciting announcement. It's Everett, whose birthday? Everett, happy birthday. Everett's our front-end engineer. Yeah, stand up. There we go. There we go. Anyway, sorry, Everett, had to do that to embarrass you. Okay, so we've got a bunch of cool stuff happening tonight. So first of all, Antonio is going to run through a little bit about dYdX, both from kind of a general overview standpoint, but also focusing a little bit more on the features of our product. We've had one very, very exciting release just very, very recently, so fresh off the press. We've launched kind of a native ETH DAI trading market. With limit orders, which has been something that our users have been asking a lot about, so we're excited to share more about that. And then we've got Brock Elmore, special guest, right here down the front, who is going to share more about his project, Topo, I don't know how to pronounce it, built on dYdX and a couple of other protocols, so really exciting to hear about that. We'll have some time for Q&A, so I'd encourage everyone to save their questions for after each presentation. So after Antonio's, we'll do some Q&A. After Brock's, we'll do some Q&A. And then we have the space till 9, so plenty of time for meeting and greeting and plenty of beers down the back where Phil is doing a great job minding all the drinks. So without further ado, I'm going to pass on to Antonio.
Your laptop too. Hey guys, thanks so much for coming. Okay, cool. So yeah, like Zhuoxun said, I'm just going to give a quick presentation and overview on what we do here at dYdX, then kind of go into our product and some of the features, and then highlighting the new thing that we just launched, which is our native ETH to DAI market on dYdX. And then I'll save some time at the end for questions as well. Yeah, so that's kind of what we're going to go over in this talk. First of all, what is dYdX? So dYdX is a decentralized exchange for margin trading, borrowing, and lending. So what is margin trading? It's not something that probably most of you are familiar with. Margin trading is just trading with borrowed funds. So for example, I could go short or get leverage by margin trading. Going short means you make money when the price of something goes down, and going leverage long basically means that you multiply your gains or losses. Kind of the way that this works is, say I want to go leverage long Ethereum and I have 100 USDC with which I can buy Ethereum. I could just go and buy 100 USDC worth of Ethereum, or I could borrow another 100 USDC and then kind of buy 200 USDC worth of Ethereum, which is basically leverage. So I would be 2x leverage long in that situation. Why would you want to do margin trading above just regular trading? The main reason people want to do it these days in crypto, at least, is to increase potential profits. But when you do that, you also increase potential losses. So you should always keep that in mind when you're margin trading. Another reason you might want to do margin trading is to utilize capital more efficiently. So if I'm like a fund or something like that, and I have a certain amount of capital with which I can trade, I might have to lock that up on a bunch of different exchanges to make trades there. But if I can make trades on margin, I can use less collateral because I have access to that margin capability. Another reason you might use margin trading is to hedge exposure. So hedging basically means you protect yourself against the downside of something going down. So by short selling, you can actually do that. So say you think that Ethereum is going to go up relative to Bitcoin or something like that. You could go leverage long Ethereum while shorting Bitcoin. And then it kind of doesn't really matter what the overall crypto market does, as long as you were right in your bet that Ethereum outperforms Bitcoin, or historically that it underperforms Bitcoin, and you make the reverse trade, then you'll actually make money based off that. So switching gears a little bit, how is dYdX decentralized? So the main way we're decentralized is all of our funds and our logic for moving those funds is contained with smart contracts, which are just programs that run on top of Ethereum. Our smart contracts are all open source, which means you can go and verify and view the source code anytime you want to, and they're audited by some of the best auditors in the space as well. People interact with these smart contracts not through having a dYdX account, but rather through just using their own cryptocurrency wallets. So you can use a wallet like MetaMask. We recently added Coinbase wallet connection and a bunch of other ones, which kind of you can interact directly with our smart contracts with. And more importantly, probably, why is dYdX decentralized? So by far the biggest point, and this is a point you'll probably see more broadly across crypto in general, is that things that are decentralized are available to everyone, everywhere. And this is really important for financial applications. We're really fortunate here in the US to have access to really high quality financial services in general, but those elsewhere kind of in the world are not always that fortunate. If we're able to kind of build a base level of financial services, which everyone everywhere in the world has access to, that's a really powerful thing. One of the really important things in finance is liquidity. So liquidity could mean a lot of things, but basically what it means is if you want to buy something or you want to take a loan from somebody or whatever really, there's somebody sitting there on the other side willing to trade with you. I really think that making financial products available to everyone everywhere is going to increase liquidity, and that's actually the reason why I think decentralized finance will win, because everybody's going to have access to these markets. In traditional finance, you oftentimes see a lot of types of financial products which are really siloed by jurisdiction. So if I'm like in China and I want to buy Apple stock or a derivative on Apple or something like that, I wouldn't be able to. Or if I'm in the US, it might be really difficult for me to invest in like Chinese equities or something like that. That's not the case with cryptocurrency if you trade it on a decentralized platform. So the second reason you might want something to be decentralized is that you can remain in control of your funds at all times. I'm sure everyone's very familiar with kind of the plethora of centralized exchange hacks over the years, but just kind of keeping funds in a centralized platform like that just really broadens the scope for attackers. I actually understand this pretty well. When I used to work at Coinbase, I worked on their hot wallet service, and even if you do a really good job of it, like Coinbase does and continues to do, it really takes like a ton of resources for the company to just kind of defend against like that scale of attack. Because basically if you're a cryptocurrency exchange and you get hacked, you lose like billions of dollars, right? So if somebody might spend like billions of dollars on multiple zero-day vulnerabilities, which has happened for Coinbase already, just to like get into that exchange. Whereas with what we're doing, everybody can use their open source verified wallet and interact with our open source verified contracts directly from that. Another thing is it's pretty cool from a product perspective, actually. A lot of people talk about how difficult it is to like get set up with MetaMask and stuff like that. And I totally agree that that's the case for now. But once you are set up with MetaMask and you understand how to use like decentralized applications, it's actually really, really easy to start using new ones. If you go and start like signing up for centralized exchanges, takes like forever. You got to like set up all your 2FA, give up like tons of KYC and all this stuff. Whereas with a DeFi app, if you already have an Ethereum wallet, you go to the page, you click for dYdX, I want to go 2x leverage long, and that's it. Like you're literally 2x leverage long after landing on the page like 30 seconds ago. Okay, so kind of moving into our actual product. Hopefully most of you have gotten a chance to actually play around with our product so you have a sense of what it looks like, but I'll be going through all the different features that our product has to offer, and then we'll talk a little bit about the native ETH DAI market that we launched after that. So the first thing dYdX offers is lending. So lending is really cool, and it's oftentimes the way kind of new people get into DeFi because they hear about it, they hear they can earn like 10% interest on their DAI, which is a really interesting proposition given that there's not too much risk to holding DAI itself. dYdX lets you earn interest really easily. You can deposit and withdraw anytime, so you can kind of treat it as like a savings account where you can just deposit money and it just sits there and will kind of earn interest for you. dYdX offers dynamic interest rates, and basically what this means is that interest rates change based on supply and demand. So lenders can always be sure that they're earning kind of the market rate for their collateral. So this is what lending actually looks like on the dYdX product. So right here is a screen where you can basically see all of your balances, and you can deposit, kind of see what interest you would earn if you were to deposit that asset. Then if you actually want to deposit some funds into dYdX, just choose what you want to deposit, and then choose the amount. You kind of can see how much interest you would earn after that. And then that's basically it. You just deposit, start earning interest, and then you can withdraw your funds at any time. Just diving a little bit more into dynamic interest rates, I touched on this a little bit before, but this is a graph of what kind of the market interest rates for DAI have looked like in DeFi over the past month or so. The blue is us, and then the green is Compound V2, and white is Compound V1. So you can see how kind of the interest rates will vary over time based on if there's more demand for borrowing a certain asset or less demand for borrowing it. The next thing that dYdX offers is borrowing. So with dYdX, in addition to margin trading, you can borrow funds directly to your Ethereum wallet. You might want to do this if you want to take a margin position but want to execute a trade on a centralized exchange, if you want more liquidity but are kind of willing to sacrifice some amount of decentralization to do that. Or if you just need access to some working capital, if you're, say, taking a long Ethereum position and you know you're going to hold that, you could basically just borrow some USDC to pay your expenses or whatever you need it for. dYdX, like pretty much all of DeFi at this point, only does over-collateralized borrowing. So over-collateralized borrowing means that you lock up collateral with value greater than or the amount that you have actually borrowed. So you have to collateralize your loans with another asset. So if I were to borrow Ethereum, I could kind of lock up USDC to collateralize that. Unlimited duration on borrows, and you can repay anytime. So this is what our borrow page looks like on dYdX. On the left here, you can see both your wallet balances, which are just like what funds you actually have in your MetaMask or whatever wallet you're using. dYdX has the concept of an account. So this is kind of like what you would normally think of as your balances on a normal exchange. Like if you deposit some money to Coinbase, you can see your money in your Coinbase account. Same thing with dYdX. If you deposit funds into dYdX, you'll see them appear in your dYdX account. And you can use those to do a variety of things on the platform, such as in this case, I'm using some of my funds that are deposited to dYdX as collateral for a borrow I'm about to take. So on this page, I'm borrowing Ethereum. You can put in the amount. You can deposit more funds if you want to increase your collateralization ratio. You can do that all on this page. A really important point and kind of thing to think about when you're borrowing or margin trading is liquidation. So what liquidation is if the value of your collateral goes down to the point where it's almost not really worth that much more than the amount that you're borrowing, you will get liquidated. And what that means is your borrow or your position will be closed by liquidators. And on dYdX, you'll have to pay a liquidation fee based on that. So you want to keep your account like sufficiently collateralized, but you can take on more risk and go lower collateralization if you want to. Okay, so the main thing that dYdX offers, and the reason it's different from other DeFi apps that are out there that you probably heard of, so things like Compound and similar, is that dYdX natively offers margin trading. So on dYdX, you can open long and short positions with leverages up to 4x. And leverage up to 4x basically means if you take a leverage long 4x position, Ethereum goes up 1x, you would make 4x the money. So dYdX automatically handles a lot of the stuff you would normally have to think about if you're margin trading for you. So it handles borrowing of the funds, it handles margining your account, so like depositing your margin deposit, and it handles trading of the funds behind the scenes. On the current product, well, I guess the product as it was like before 2 weeks ago, dYdX integrates with open decentralized exchanges. So things like 0x, things like ETH to DAI, which is MakerDAO's decentralized exchange, to do the trading behind the scenes. A really important point if you're going to be doing margin trading on dYdX is we offer two different types of margin trading. And this is something we get asked about on the product a lot, so I thought I'd go through it. And these have to do with how your positions are margined, which basically means how the collateral is going to back your position. So the two types of trading we offer are isolated trading and cross trading. So for isolated trading, which is probably the easier one to use and get started with, and that's the one we'll default people to on our app, each position is collateralized independently. So that means I could have multiple leverage long positions, or I could have multiple short positions, and each one of them will have collateral deposited for that specific position, and it will get liquidated for that specific position if it comes to that. And like I said, that's probably the easiest way to get started with dYdX. Cross trading, which is something that we're personally really excited about. I think for most of the people that understand the app better, they actually prefer to do cross trading because you can have a lot more control or customization over your actual trades. Like most of us at the company, when we trade on our product, or kind of one of the things we do as a company is we hold trading competitions. So when we have our trading competitions, you'll see most of us just kind of using cross to actually make our trades. And the main thing for cross is that all of your trades are collateralized together. And remember when I said that there's the concept of a dYdX account? So basically this over here, those are the funds that are used to margin your cross trades. I think the best way to think about cross is it's just like using a normal exchange. So it's like using Coinbase, except you can go into debt, and which basically means that you can have negative balances. So it's like if I went on Coinbase and I had like 10 Ethereum, I could only sell 10 Ethereum, right? Because it's not going to let me sell more than I have. But on dYdX, if I come and I put in 10 Ethereum, I could actually sell 20 or 30 Ethereum because I can have a negative balance of Ethereum provided that I have enough collateral and other assets. Okay, let's see if this is going to work. Looks like my videos are not going to work today. Maybe we can go on the actual website later and play around with some stuff. Okay, well, let's talk about the native markets on dYdX then. So one of the things that we launched just a couple days ago was the ability for people to make limit orders on dYdX. And what limit orders are is basically that you can offer to trade at a certain price. So you could say, I want to buy Ethereum if it goes down to 150 DAI. Right now, nobody's going to sell you for Ethereum for 150 DAI because the market price is higher than that. But you can basically enter into a margin position at a particular price. Previously, as I mentioned, dYdX plugged into other third-party decentralized exchanges to do our buying and selling. So we plugged into Radar Relay and then ETH to DAI. One of the things that is really important for exchanges in general is this concept of liquidity, which I mentioned before, but is basically if you want to buy something, there's got to be somebody sitting there willing to sell it to you. A lot of our users at dYdX are really power users, and that's kind of the way we've built the product in general. We've built it to be very powerful, to be very customizable, such that you can do exactly what you want to do on the product. But on the flip side, that kind of makes it difficult for people to understand what exactly is going on. So at this point, we've mostly been targeting more whale-type users. So these are people that are trading a lot of cryptocurrency at the same time. On dYdX, our average trade size is actually over $5,000 right now, because it's kind of heavily weighted by people who are making trades of up to like 25,000, or you've even seen up to sizes of $100,000 worth at a time. So one of the really important things for us is that we have the liquidity to support those kinds of trades. And this liquidity, as you probably heard, doesn't really exist yet on most decentralized exchanges. It's just really hard. A lot of them have technical limitations, which make it very difficult for market makers to efficiently provide liquidity. Chief among these is, and there are kind of different levels of offense for this, but for a lot of decentralized exchanges, you have to basically send transactions to the blockchain to do things. So for ETH to DAI, which is an on-chain exchange, you basically have to send a transaction to the blockchain anytime you want to place an order. This is obviously pretty expensive because you have to pay gas fees, but even worse than that, there's a lot of latency when you send a transaction to the blockchain because it's not going to get mined for like 15, 30 seconds or even longer. With 0x, kind of their main claim to fame is that you can offer trades without sending a transaction to the blockchain. So you just cryptographically sign a message, give it to a 0x relayer, and then people can start taking it. But market makers, one of the things that they normally do is cancel orders. So if you're a market maker, basically what you're doing is you're running a trading bot, which like makes some orders, then it looks at the price. If the price changes, you'll cancel those orders, maybe make some new orders. So you're kind of making and canceling orders all the time. With 0x, as it currently stands, you basically need to send a transaction to the blockchain to actually cancel your orders as well. And again, this is really slow, really expensive. It's kind of indeterminate state when you send the transaction. You don't know if it's actually going to get canceled or it's going to get filled before the cancel gets mined. So there are a lot of drawbacks to it. With what we're doing, we've kind of based our exchange model on the 0x matching model. So we're not using 0x, we're kind of using smart contracts which operate similarly to that, but are custom built for dYdX. And we basically based our exchange off of what's called the matching model execution. And with the matching model, there's a centralized party, so in this case, dYdX and our servers, which is storing the entire order book and sending all the fill transactions. So basically what we do is we store all of the orders that are on our order book, and then if the order book ever crosses, we'll send a fill transaction to basically execute the fills and kind of make those trades peer-to-peer with those orders. This has a lot of advantages in terms of you can get free and instant order placing and cancellation, which is really important. And then with what we're doing, you can also offer limit orders and market orders on margin, which is kind of the first time this has ever natively existed for a decentralized exchange product. So with dYdX native markets, we launched them alongside our other existing open DEX markets. And we did this because we are committed to basically serving those markets, and they also have a good amount of liquidity for now, and they kind of have assets that we are not able to support. So on dYdX, on the market selector, you can choose to use our markets, you can choose to use other markets, and it's really up to you. This is another video. Let's go into how the limit orders work. So like I said, kind of the high-level architecture of how it works is with off-chain signed messages. So when you make a trade on dYdX, now instead of sending a transaction, you will be asked to sign a message. And this message that you're signing is an order, fairly similar to a 0x order. So it has fields like the amount you want to buy, the amount you're willing to give up in exchange for that, the actual assets that you're buying, and some other stuff that's kind of related to our protocol. And then you can cryptographically sign this message with your Ethereum wallet. Then once you actually have signed your order, our front end will send the order to our servers. On our servers, like I said, we're storing the entire order book all the time. So we have a matching engine that we've built, which will store all of the orders in memory. Every time a new order comes in, we basically check to see if it crosses any existing orders. So in this instance, someone wants to buy 10 Ethereum at 200. There are some existing sell orders which are offering to sell for 195 and 190. So in this instance, this order will cause a fill. And our servers will be the one to send the fill transaction to our smart contracts. This is pretty nice from a UX perspective as well, because you don't have to be the one sending the transaction. You don't have to deal with gas fees. You don't have to deal with kind of MetaMask being weird and like dropping your transaction randomly and things like that. And we'll take care of all of that for you. Then once the transaction actually hits our smart contracts on the blockchain, our smart contracts will validate the signature and kind of the collateralization of all the accounts after the order. And if everything is valid, everything is good, our smart contracts will update the balances internally on people's dYdX account. So an important point to note here is that there aren't actually any tokens moving when people make a trade. Basically, people are just trading in between their dYdX account balances, which makes it a good bit more efficient because you don't have to deal with moving tokens around. Okay, cool. So that was all the product stuff. We'll leave some time at the end for questions on that as well. Now I want to go into our roadmap in terms of what we're going to be doing next at dYdX. So obviously we just launched our native dYdX market. The thing that we've launched with that is only cross-trading for now. In about a week or two or so, we're going to be launching isolated positions on our dYdX native market. And this will be really cool as well because, again, you will be able to enter into an isolated position by simply signing a message. And that signed message will authorize your margin deposit, kind of your trade, and everything else on top of that. So we're pretty excited about that. Right now, dYdX only supports Ethereum and then DAI and USDC. We obviously want to add more assets that people want to trade. Probably the biggest one that we're looking at right now is wrapped Bitcoin. And then we're also looking at other probably like large market cap ERC20 tokens, I would say. And then a little bit farther out, one of the main things we want to add, and which is a common feature you'll see on exchanges, is stop loss orders. So what a stop loss order is you can basically stop yourself from losing too much money on a trade. So if I enter into a long position, I could put a stop loss order to basically say, just close my position if I've already lost like 30% or something like that. Some developer resources. So we put a lot of work into updating our developer documentation, especially with the launch of our native ETH DAI market. So you can find all our docs at docs.dydx.exchange. We have a full-featured TypeScript client, which will allow you to interact with the protocol as well as interact with our native market. We recently released a Python client as well, specifically designed for trading bots. And these two clients will make it really easy to actually build trading bots on top of dYdX. It's pretty cool because it basically feels like a centralized exchange in terms of you don't really have to interact with the blockchain very much. You just like input your private key to the constructor on the client and it will handle everything like signing of all of the messages and everything for you. And then of course, like I've been mentioning, our smart contract code is open source and available on GitHub. So that's all of it for now. I was hoping to be able to, Zhuoxun, do you maybe want to, do you have like a MetaMask with money in it that I can use? Okay. Okay, yeah. I guess while we're setting that up, we have time for a couple questions. So does anybody have questions on anything that I've covered so far? Yes. It's more like the second thing. So because the interest rates are dynamic, you can see what the interest rate is right now. You can also, there are really good products like, I would recommend LoanScan, which you can see historical interest rates for dYdX over time, which you can kind of use to inform what the interest rate might look like. Of course, that's not a guarantee of what it will be. But yeah, it's dynamic over time. Actually, one of the things that we're really excited about are things like what Brock is going to present in a little bit, which are going to be like aggregators across a bunch of different lending protocols. So you can ensure that you're always getting the best interest. So it might like lend part of your funds on dYdX, or if Compound has a higher interest rate, it'll like switch your money over to there. But he can talk a lot more about that. Yeah.
I'm curious about the negative balance. So what happens if the guy to avoid that? How do you left it?
Yes, so with negative balances, basically the thing that you need to have in order to have a negative balance is you need to have collateral in another asset. So say your negative balance, you're borrowing like 100 USDC, you might have 150 DAI serving as collateral for that borrow. Then that probably wasn't a good example because probably the price of USDC isn't going to move. Well, say like DAI collapses or something like that, which hopefully doesn't happen. But then your account would get liquidated if the value of your collateral is a little bit like almost not going to be enough to cover like your borrows.
So the question is, it actually happens on a cross side, right? So cross is already calculating all the balances in your account.
Right.
How do you have a separate account as collateral?
Actually, Cross just uses your main dYdX account. So it uses the exact same account that you would touch if you were lending on the product or borrowing on the product. Everything uses that account except for isolated positions, which, like I mentioned, are like margined independently. Yes?
I know Compound, it takes some profit sharing. You guys do something similar on the interest?
Yeah, so probably what you're referring to is Compound and us actually is a very similar idea. Basically, we'll both take a small fee as part of interest that is earned on the platform. Right now, that fee on dYdX is 5% of interest earned on the platform. And the reason that we do that is that money right now is going to fund an insurance pool. And it basically just sits in the smart contract. And if any of the accounts are failed to be liquidated in time, that insurance fund will be the first funds that are kind of used to basically collateralize the protocol in case like it wasn't liquidated in time. Yeah. Mm-hmm. Right now, it's not possible to basically take money out or put more money into an isolated position. This is actually one of the reasons you might want to use Cross. So like I was mentioning, Cross basically just works with your main dYdX account balances. And you can do everything with Cross, basically, that you can do with isolated positions. So if you were to go leverage long with cross trading, you could just deposit more funds into your dYdX account if you wanted to achieve that. Okay, cool. I'm going to try to go through some of the product stuff now, and then we can return to questions after that. All right, hopefully all of this works well. Okay, cool. So this is what we have just launched a couple days ago. You can see our limit orders right over here. And this is our native dYdX market. And let's try to place a trade right now. So again, this is just using cross trading. Interestingly, this is a good example of Zhuoxun's DAI balance right here. If I were to make this trade, is going to go from positive to negative. So basically, I'm using more DAI than I actually have to buy this amount of Ethereum. And consequently, I would go from earning interest. So all funds on the platform always earn interest. Doesn't matter if you deposit it to lend, if you use it as collateral for your position, all positive balances are always earning interest. Okay, so let's try to actually place this trade. And this is what I was showing before. So here, I'm not actually sending a transaction in MetaMask. I'm just signing some data. And this data is transparent to you. So you'll actually be able to see, though it's a little bit cryptic, what you're actually signing here. Hopefully this will improve with MetaMask over time. But you can kind of see the amounts that you're going to be trading at, all the other things that you're about to sign. So if I were to sign this order, so now my balances are going to update here, and you can see the pending balance that they're going to update to. You can see that you've just placed an order right here. So this was a market order for buying 0.1 ETH. And you can also see, even though this transaction has not been mined yet, the fill that's about to happen. And that's this right here. So you basically know with almost close to 100% probability or certainty that this trade is going to execute successfully before it's even mined on the blockchain. And the reason that we can know that is because we're the ones sending all the fill transactions, and we have pretty much a perfect view of all the fills that have been executed and all the orders that are valid and have been canceled in our actual database. So once this transaction gets mined, I think the network was a little congested today, you will see your balances update in the app. So that's basically an example of how you can use our new dYdX market to really easily just make a cross trade. I think cross trading is really interesting too because it's purely a superset of what you see on other decentralized exchanges. So one really cool thing is you don't actually have to use dYdX for margin trading. You can just use it for normal trading too. You can just cross trade, just buy and sell things like you would on any normal exchange. Just have this cool added feature that if you want to, you can always go into debt and have negative balances. It's also cool because while you're trading and you have your funds deposited here, they're all earning interest. So you can kind of do all of the things you might want to do in one platform. And here you can see my fill transaction has finally gotten confirmed. Okay, cool. So let's actually stop there. Does anybody have questions specifically on some of our dYdX native market stuff that I can answer? Yes, in the back. No, the transaction's sent to the blockchain like immediately. But the thing that I meant is that no like ERC20 tokens are transferred. They're all just kind of sitting in our like big lending pools. But what you will see is your balances update on dYdX. So like after I made that trade, now you can see, like I was saying, like my balances have already updated on the app. Yeah. Yes. Sorry, can you repeat the question? Yes, that is a good question. So right now, that will basically make our fill transaction revert probably, which our backend can recover from. In the future, we might add the ability. There's nothing stopping you from doing that on the smart contracts by design, right? Because we don't want to like lock people's funds up. But that's why I said there's like a 99.9% probability that we know what's going to happen when you send a fill transaction. But the two things which could basically get in the way of that are like you or one of the makers that you got matched with withdraws funds, and then they don't have the funds to be able to trade with anymore, or the price changes, and now those trades that we thought were going to be valid, like the Oracle prices change, and now like after that trade would execute, now the account would become under collateralized. But the cool thing is that our smart contracts verify the validity of all trades at the time they get mined. So nothing's ever going to go like horribly wrong. It might just be that we have to send like 2 fill transactions instead of 1. Basically, if our first one, we send it and like it reverts, we'll see that, put all the orders back on the order book, and then just try to send like another fill transaction after that. That's a good question though. Okay, cool. Any more questions on our dYdX native market? Yes.
Yeah, is there an understanding of like a buy, for example, DAI, it's got a 10% interest rate, but USDT might have 5. Do you have an internal understanding of why that might be?
I think the biggest thing right now that a lot of these rates are based off is the stability fee on DAI, and that tends to inform like what the actual market interest rates on some of these open lending platforms like us and Compound are going to look like. So I think it's really based off of that, and that in turn I think is really based off of how much people want to margin trade, specifically margin long Ethereum. So this is kind of going a couple levels down, but the reason you might create DAI in the first place is the same reason you might want to use dYdX. It's to go leverage long Ethereum. So when the price is going up and there's like a lot of enthusiasm, everybody wants to go leverage long Ethereum because like, you know, crypto's going to the moon, like why not be leveraged while it goes to the moon? So people want to open DAI, want to open CDPs specifically to mint DAI, and that causes the price of DAI to go down actually because there's a lot of demand for opening CDPs, for minting DAI, but that might not match the amount of demand there is to actually own DAI. And the main way that Maker has to respond to this is when you open a CDP, which again is what you need to do if you want to mint DAI, you need to pay an interest fee to keep your CDP open. It's very similar to if you were to open a leverage long position on dYdX, and then you would have to pay some interest on the DAI that you were borrowing. So if the price of DAI is below $1, Maker will increase the stability fee, and that's basically what we've seen happen, because pretty consistently for like, I don't know, 3 months or something like that at least, the price of the DAI was like 97 to 98 cents. Which is pretty obnoxious if you're trying to build and people are trying to use a stablecoin. You don't want it to be worth 98 cents. So what they did in response to that is they raised the stability fee. They raised it pretty high, actually. I don't know what the highest it got was, maybe like 20.5% or something like that. And that caused the actual rates that you can earn on open lending platforms like us and Compound to go up to similar levels. Now what you're seeing happen is now the price of DAI, because people don't want to go leverage long Ethereum that much because the price is falling, is going up because there's not a lot of demand to open CDPs, and the interest rate, the stability fee is too high. So now what Maker has started to do, and they have some whole decentralized governance process of doing this, is lower the stability fee. So now it's down to like, I don't know, it's hard to keep track, but like 14.5% or something like that. And you see the interest rates on US and Compound being very similar to that. On US and Compound, basically the way it works is that the borrow interest rate is always going to be greater than or equal to the supply interest rate. And the reason that is because the borrow rate is shared amongst all the lenders. So the really important concept you want to know if you're trying to understand how interest rates work on US and Compound is this concept of utilization. And what utilization is basically just the total amount borrowed divided by the total amount supplied. So say that's like 50%. So for every 2 DAI that are lent, 1 is being borrowed. And the reason that's important is because interest is only being paid on that 1 DAI that's being borrowed, right? So it has to be shared amongst the 2 guys that are trying to lend it to you. So in that instance, you might see the supply interest rate being somewhere around half of the borrow interest rate. Right now on dYdX, it's a little hard to see right now, but I think our interest rates are, yeah, about like 13.5% and like 9.5%. So like I said, this is really close to the stability fee on DAI, right? Which kind of makes sense, right? Because margin traders have an option of where they can margin trade. They can margin trade on MakerDAO, they can margin trade on Compound. It's a little bit harder because you have to make your trades yourself there. Or you can margin trade on dYdX. So it's just kind of like arbitraging the interest rates across those different things. And I think that's why you'll see a lot of these borrow interest rates kind of move in step for all of these products across DeFi. The reason everybody, well not everybody, but pretty much everybody is borrowing on DeFi right now, including Maker and Compound and everything, is for margin trading. Because people want to go leverage long or go short. So it's a pretty similar use case amongst all these products. Yes?
So they're borrowing DAI, and then you think they're going to split the borrow, they're going back and buying. What is the most common? Do you have any idea of whether they're using that borrow DAI?
To buy Ethereum and go leverage long Ethereum, yeah.
So they lock up their ETH to CDP, they get the DAI, and then
They go and buy more Ethereum. Kind of. If you were to use MakerDAO by yourself, what you would probably do is just lock up a bunch of Ethereum, then borrow some DAI, and then buy more Ethereum to kind of cover the Ethereum you had just bought. And that's basically just getting leverage right there. It's a multi-step process if you use MakerDAO or Compound, because you have to basically borrow, because those apps don't support trading, they only support borrowing, and then maybe go to like Coinbase or some other decentralized exchange and make the trade there. With dYdX, you can do that all at one time. And also importantly, on dYdX, you can do it atomically. So on Maker or Compound, you basically have to have all the collateral that you want to put up front. So maybe I have some Ethereum, I like put that up, and then I borrow something, and then maybe I buy more Ethereum, or I don't. On dYdX, you can basically put up less collateral because the amount of ETH that you would get from doing the buy with the borrowed DAI gets put in your account atomically at the same time in one transaction. So you can make trades with less overall collateral. Okay, cool. I guess the last thing I just wanted to show really quickly, and like I said, this will be available soon on our native dYdX market, is taking an isolated position on dYdX. If you want to get into margin trading, you haven't tried it yet, this is what I would recommend you start with, because it's kind of the easiest to see like what actually is going on. So right now I'm on the ETH to DAI market, and you can see this is the order book from ETH to DAI. On dYdX, you can go long or short. Long, you make money if the price goes up. Short, you make money if the price goes down. And then you can choose the size of your position that you want to enter into. The really important thing to know when margin trading is the concept of leverage. And this is just like the amount that your position will be multiplied by if you make money, and also the amount that your losses will be multiplied by if you lose money. So double-edged sword. dYdX, like I said, supports leverage up to 4x. So I can open a leverage long position, and you can come right to the app and do this. This is kind of the cool part, like I was saying, because if you were a new dYdX user, you never used dYdX before, you would land on this page with your MetaMask wallet. There's no sign up. All you have to do is put in like whatever amount you want to trade here, put in your leverage, and then just click this button. And that'll prompt you to, this is actually sending a transaction to the blockchain. So once this transaction gets mined, you'll have a position that opens. On dYdX, you can see all of your isolated positions independently. So this one, which just mined and got confirmed, is open right now. You can see like your profit and loss, like your current leverage. The leverage will change over time as you either make or lose money. You can see what price you'll be liquidated at, see what price you open it at, see how long until the position expires, all that good stuff, and you can close it anytime you want to. I'll leave this position open for Zhuoxun because this is a good investment. But yeah, so any questions on specifically isolated trading, and then we can open it up to more general questions after that as well. Okay, yes. Right now, it is, yes, all US persons using our application have a fixed expiry date set to 28 days from whenever they open the position. For people that are not US persons, they can take trades with unlimited duration. Okay, cool. Any other questions on really anything that I've talked about or that you're curious about dYdX? Yes? Yes, I would say so. I would say like the really big thing about leveraging existing lending protocols is it's a lot more difficult to have interoperability between lending protocols than it is to have interoperability between exchange protocols. And the reason for this is because all lending in DeFi, like I mentioned, is over-collateralized. So the way everyone's smart contract works is they ensure that their smart contract is the one to have the collateral at all times. So say, I don't know, we had chosen to build like dYdX on top of Compound or something like that. It wouldn't really work that well because like our contracts would want to know that the collateral is there, and Compound's contracts would want to know that the collateral is there too. It's possible we could have just like trusted Compound's contracts to, you know, say that they have the collateral and that they're audited and all of that. But we wanted to build our own because we felt that like that gave us a lot more control. And we have I would say we have a more specific user base that we're targeting than at least what my understanding of Compound is. We're really specifically targeting margin traders, and we're trying to build the best possible product for margin traders, and we think the best possible product for margin traders is this really professional type interface. Whereas with Compound and other lending products out there, it's kind of a much more general use case. They're not really specifically marketed at margin traders, even though like functionally that's basically what they're being used for anyways. So we felt like one of the things margin traders care a lot about is leverage. So oftentimes you'll see people want to go to exchanges which you can trade on with higher leverage. dYdX will offer a higher leverage than Compound's contracts. If we had used Compound's, like we would only be, they liquidate their accounts at 133%, which basically means you can't have as much leverage as dYdX is offering. So we couldn't have had like high leverage. There's a bunch of other reasons why we did it too. But yeah, we felt like it was a worthwhile investment, and we felt like we had the talent to be able to go out and build like a similar competing lending protocol. So I think it was a good decision. Yes. What was the last part? Okay, so I guess the question was about what does trading volume look like on dYdX, and then how can you tell if it's just being faked or spammed or something like that. So responding to the first part, what does actual trading volume look like? So it varies quite a lot with market dynamics. Traders in crypto more broadly, as you probably know, want to trade when the price is moving and when things are either going up or going down. So we saw a ton of trading volume I guess fairly early on when we launched the product, and that was around the time when Ethereum was at like, I don't know, it went from like 70 to like 300 something. People were buying a lot, and we topped out at about, I think our best day so far was 5 million USD traded about. These days, we're kind of seeing volumes more in the range of like, I don't know, 300K or something like that, but that's the case for crypto more broadly. I think the really interesting thing for us is just like thinking about our volume in terms of other exchanges. Right now, as probably everybody knows, like centralized exchanges probably have like 0.9% of the market share for exchanges. So we're pretty focused on winning the decentralized exchange space for now. Our volume has been pretty comparable. Right now, we've been basically pumping volume into 0x and ETH to DAI as we trade there. So our volume has been around like half of the volume on Oasis or ETH to DAI pretty consistently recently. So that's probably the main metric. Then to your point on trading bots, that's not something that we've seen, at least in our investigations of kind of what goes on our platform. People, especially because people have to pay for their own gas right now, it's not really worth it if you're just trying to like send a bunch of transactions to like spoof volume. And if you want to send like bigger trades, you've got to actually commit a lot of capital, which has a real cost associated with it. It's not something that we've seen on our own exchange yet. We don't charge fees on the exchange, on our native markets right now, though we may in the future. But yeah, definitely something we'll keep an eye on. Yes. Yeah, absolutely. That's a great question. So there are a number of risks you should consider if you're going to use a decentralized financial product. I'll talk specifically about ours for now. So the main thing that you have to worry about, and all of you probably know this, is the security of your actual Ethereum wallet. So this is like the thing where MetaMask shows you like the seed words at the beginning. If somebody knows those, they get all your money. So don't lose those and like keep them in a secure location. So that's probably like the first like area of risk. The second area of risk I would say is technical risk. And there are a couple different things you have to worry about there. So there could be a bug in MetaMask, though that's been pretty stable and secure for its lifetime so far. There could be a bug in our front end code, or there could be a bug in our smart contracts. We put a lot of effort into securing all of our code. All of our smart contract code is 100% tested in terms of like branch and line coverage. We got it audited by OpenZeppelin, which in my opinion are the best auditors for smart contracts, period. So we're pretty confident in the security of our actual smart contracts. We have bug bounties, kind of, I think, at least doing all the right things there. But absolutely, it's something you should consider if you're going to use any decentralized financial product. There is a risk that if there's a smart contract vulnerability, in the worst case, all of your money would be gone. So those are probably the main things. The other things maybe to worry about that you might not immediately think of are smart contracts that are not dYdX smart contracts having vulnerabilities in them. So that could happen if we're, say, for DAI itself. So for DAI itself, DAI is just a smart contract, right? So it could have a vulnerability. All the collateral for DAI could be compromised, in which case DAI would probably go to 0. So you don't want to be holding DAI if it goes to 0. But those are probably the main things to think about. I would encourage everyone to try to understand what are all the different products that you're actually using. So all the different smart contracts that you're actually using behind the scenes. So for example, for this isolated trade that I just made, we're obviously using dYdX, obviously using DAI. We're maybe a little bit less obviously using ETH to DAI, which is an exchange. That could have a vulnerability in it too. So as you start kind of layering on these smart contracts, it starts getting just like, it's basically like multiplicative, like probability that something goes wrong, right? So absolutely, it's a good thing that people should consider. I think like security of smart contracts will continue to improve over time, but I would really encourage everyone to only use decentralized financial products that are built by people that know what they're doing and people that take security really seriously and have been audited by quality auditors and all of this. Yes? I probably would not put 100% of my net worth in dYdX, though. We put a good amount of, I put a good amount of it, not all of it. I wish I had more to put in. We also do use, this is surprisingly real. We also do like put funds, company funds into our protocol, and the reason that we do this is right now we're the ones doing maybe like 50% of the liquidations on our platform, and to do liquidations right now you have to have money locked up on the protocol. There are also a bunch of third-party people that are doing liquidations right now, and we've built a really good liquidation bot, which I encourage all of you to check out if you're at all technically savvy. It will basically just let you liquidate accounts on dYdX. And that's cool because if you liquidate an account, you get a 5% fee. So you can basically just kind of make, not free money, but better than expected value money as you're liquidating accounts. But yeah, that's kind of my thoughts on security of our protocol. Okay, any more? Oh yes, in the back.
You mentioned that American users are subject to 28-day limit. How do you protect against Americans coming in with a VPN?
Yeah, that's a good question. Right now, we do basically only, identify American persons through their IP address. So you could potentially do that. Obviously, it's against our terms of service. So we don't want to service. Sorry, we do want to service U.S. persons, but we don't want U.S. persons taking out margin positions that are longer than 28 days. So we do everything in our power that we can to block those types of users from using the protocol in a way, or specifically our product in a way that's not in accordance with U.S. regulation. But yeah, that's a reasonable question, something I think a lot of exchanges more broadly are thinking about when you can come to the exchange with only an Ethereum wallet. Okay, cool. Any more questions before I hand it over to Brock? Yes. Yes, yeah, that's the type of thing I was mentioning in terms of why it's important that our front-end code is secure. Also, there have been hacks with exchanges in the past where basically they just they like take over their DNS or something like that, and they swap out, attackers will like swap out the code that's sitting at that like URL with a code that basically just prompts you to send transactions that just like steal all your money or something like that. So yes, it's really important that our front-end code is secure as well. One of the things I really want to see more of in the future is better wallets, basically, for using decentralized applications, because basically at the wallet level, like your wallet knows what you're doing, like at a technical perspective. It's just a question of whether it surfaces that to you in an effective manner such that you, a human, can tell what's going on. And right now, clearly, you're not going to look at like all the bytecode for like the transaction we're about to send in your wallet and like make sure that that's like going to do the thing that you expect it to do. But there's no reason why like MetaMask or some other wallet couldn't build like a dYdX thing which knew how to interpret dYdX trades and could basically ensure that you're actually sending the right thing. We're trying to take steps in this direction. Like I showed you that signed message, which you can actually see in MetaMask what you're signing. You might not look at all of it, so it's a work in progress, but you can kind of, that's like maybe the beginnings of being able to see what you're about to send to the blockchain. But I absolutely think that's an important thing that needs to be improved on in the future for DeFi more broadly. Okay, cool. Well, thanks so much for all the attention and good questions. I'm going to hand it back over to Zhuoxun now.
Thanks, Antonio. So I learned a couple of things. I'm now negative DAI, which is not ideal, and I'm long 4x ETH unprofitably, it seems. Cool. Anyway, so I want to introduce Brock. Just for a bit of context, Brock has been a really, really strong just community member for a really long time now. When we first went live a few months ago, he was probably the first guy that really like got deep in the protocol and was asking a ton of questions. And since then has basically been evangelizing dYdX, just unstoppably. So we really appreciate that. Thanks for coming in. Be kind, he's just jumped off a 10-hour flight from London. So thanks, Brock.
Awesome, thank you.
Where's the...
Awesome. So thank you for that intro.
like you said, my name is Brock Elmore. I'm the co-founder of Topo Finance, and what we are is we're an open finance service aggregator. So we're optimized. Sorry. So we are optimizing usage of various DeFi protocols, for example, dYdX and Compound and Fulcrum. So who am I? I got into crypto in 2014. I started a Bitcoin trading family office hedge fund. And when dYdX launched, I got super into what they were building. And at that time, DAI had about a 30% APR. And if you took a 4x short against ETH, then that bumped up to 120% APR, which that made me start to wonder, how is this happening? It felt like magic. And so push button get leverage was something that really drove my curiosity into how this all worked. And so one of the main aspects of it for me was the interest rates. And so I kind of want to talk about how interest rates work in this ecosystem and how that applies to what we're building, which is an optimized yield across various protocols. So up here I have historical interest rates for Compound, dYdX, and Fulcrum. As you see, Compound is pretty stagnant, not a lot of movement versus dYdX, which is the purple. Lots of spikes, and I'm going to talk about why that is and why it's actually a good thing in a lot of ways. So this is going way too deep. Basically, I just want you to take away that Antonio mentioned the concept of utilization. So utilization is just borrows divided by supply, essentially. And for all of these protocols, the supply rate is determined by the borrow rate. It's always some fraction of the borrow rate. And so you know this concept of utilization. It looks like the x-axis got messed up in this, but that should be 1 to 100% utilization on the x-axis, and on the y-axis you have the corresponding interest rates for dYdX. And as Antonio mentioned, borrow rate is always above the supply rate, but I want to dive in on this idea of why there's this hockey stick towards the end when you're going towards high utilization. And that's actually a measure of the risk of not being able to take out your money from lending. So when you are lending on these protocols and someone borrows against your funds, that money is being used. And so you technically don't have access to it if it's all being used. And so let's say you have 1 million DAI on dYdX, and the utilization is at 99%, the chances of you being able to withdraw all 1 million DAI is pretty small because it's all being lent out. Conversely, at 70% utilization, you're probably going to be able to pull out your DAI. So this is a good example because you have incentive mechanisms here where as you approach that high chance of not being able to pull out your DAI, the interest rates that the borrowers pay goes up very significantly. And so what that does is it incentivizes borrowers to close positions, or it incentivizes users to put more supply in. So that if you recall those spikes come down very quickly. Now I want to switch gears and talk about Compound. So Compound, they have a linear interest rate determination. So as utilization increases, the borrow side only increases on a linear scale. So you don't have that as strong of a utilization or incentive mechanism for borrowers to not take out borrowers when you approach high utilizations. What this means is about 2 months back, Compound actually reached 99% utilization. If you wanted to withdraw almost any amount of your lent DAI, you could not do it. And I'm pretty sure they're the only protocol that has had this issue, but it's because of this misaligned incentive structure. And so I just want to call attention to how some of these things work as we start to use them and how you can align incentives correctly. So now I've talked a little bit about these interest rate functions and how they're just driven by these simple math calculations. What we're doing at Topo is you can actually use some more math on top to allocate all of your funds efficiently across these three lending protocols. So dYdX, Fulcrum, and Compound all have similar functionality on the lending side of things, such that you can place your money with us and we will allocate it efficiently and rebalance it as the rates change. So there was a previous question, how will I know what I'm gonna earn in the future? You don't necessarily, but with our product, you can at least know you're getting the best rate. And so I wanna talk a little bit, we're on Google Sheets or PowerPoint instead of Microsoft, so some of the diagrams will be a little funky, but for us, basically what happens is a user deposits and it goes into this rebalance function. And I'm sorry if there's not many technical people in the room. I will try and be brief on this. But what we do is we run some off-chain calculations and basically check what is occurring in the state of dYdX, Compound, and Fulcrum. As Antonio was talking about earlier, there's this compounded smart contract risk. And so what we're doing here is we're trying to minimize any possibility of this smart contract risk by having a whole bunch of checks that around each of the systems. And so once we've confirmed that the state is how it should be, we will move your funds from whichever protocol it should be to from the other one. So that's a little too technical. I just want to touch a little bit more. We're doing the lending side, but we're also doing the borrowing side. So if you have questions on either the lending or the borrowing side, I know the market very well on a very deep level, not just dYdX, but if you want to know how any of this stuff works, I'm very happy to talk about. In addition to these yields, though, on interest rates, we're also going to be optimizing for a number of other trading strategies. So, for example, arbitrage. As someone asked earlier, you can borrow USDC for about 6 to 8%. So what you can do, and I believe you can actually do this natively on dYdX, you can stay long ETH. You can borrow USDC at 8% and trade it for DAI and lend that DAI at 12%. And so you're maintaining your ETH long while capturing that about 6% extra interest, the delta between the DAI lend rate and the USDC borrow rate. And so we're building these and going to be allowing you to borrow USDC at the lowest rate and lend DAI at the highest rate. And so adding interoperability between these lending protocols. And so now I just kind of want to switch gears. I've talked enough about myself, and I really just want to talk about how awesome it is to be able to build on all of these things. And so I'm going to just throw an idea out there to hopefully inspire some of you to go and build on projects like dYdX. And so this is called the anti-lock proposal. Help, I lent my money on Compound and I can't get it out. So this is the scenario before where I was talking about when Compound was at 99% utilization. And basically what I'm proposing here is essentially a smart contract that holds a balance in dYdX, for example, and when a Compound user wants to, let's say a Compound whale, they have 1 million CDAI, which is if you're familiar with CDAI, it's a tokenization of the interest that you're earning on Compound itself. Basically, it represents the DAI that you're lending on Compound. But it's not a very liquid market. So let's say the utilization is at 99% on Compound. Normally,
if it's lower, I can go and redeem my CDI for DAI and exit my lending position. But if if the utilization is high, then I either have to trade or just wait for the utilization to fall. And the issue is it's a very illiquid market. And so basically all this does is it allows, I'm just going to skip ahead. CDI would deposit into your smart contract, the unlocker smart contract, which would basically route the CDI into the unlocker contract, and the unlocker contract would send DAI minus a fee to the compound user. And so what this does is the unlocker people are like, yes, I will take the short-term locked CDI with the understanding that I will be able to redeem that later, and I'll do that for a fee. And so the CDI holder wins because they are able to exit their position at lower than the slippage that they would incur by selling it in the open market like Uniswap, and the unlockers win because they get a fee for doing so. And so it's just one idea of how you can kind of work around kind of the struggles of the underlying protocols and actually create something interesting, as well as just how fun it is to build on this stuff and how many interesting aspects there are to this money Lego concept. So in general, building on dYdX is fun, and there are tons of possibilities for composability. Not all lending protocols are created equal. Topo Finance can help you optimize across protocols. Come ask me questions. Follow me on Twitter. Follow Topo. And thank you to the dYdX team for inviting me out. It's great to meet you guys. And yeah, thank you.
Cool. That's the official stuff that we have planned. So we have a bit of time. Come grab a beer down the back. We'll all be hanging out. If you want to ask Brock or Antonio or any of our team questions, please do. We have one plug that we're going to make, that we have to make. We are hiring across engineering and design. So please come and talk to us. And Jill, who's our recruiter, who's right here, if you are interested. But thanks for coming out, and come say hi down the back.